We can change the pricing of what we're selling things for to make the most profit. When we have a 3-year contract on a lease, we're not going to be able to change that maybe for 3 years. So our focus is we're going to be covering that expense, but it's not going to change until we renegotiate, right? What else? I think one thing that I like they have an MIS system. So they are monitoring their inventory. They have a system in place that allows them to track it. And that's a good thing. And I would be interested in knowing how good a job maybe they're doing on that. So they have the ability, something that we aren't going to do in this class, but they have the ability to analyze by SKU or by item where their profitability is easily. And Diana, I'm sure, does that by her items too, and you may know that eggs are more profitable than something else. And when it gets down to cash time, I know what I would focus on. I'm obviously going to focus on the most profitable thing that I sell. And sometimes when we get to analyzing some of those things we sell, we are amazed by some things just aren't as profitable or maybe not profitable, right, as we thought they were. And that can help us focus on bringing more to the bottom line. So maybe when we have the opportunity to change our inventory structure, maybe we change it to the most profitable item and turn that faster rather than maybe some peripheral stuff that we have a bunch of inventory invested in that we're really not even selling. And what's that doing? It's kind of just eating up money sitting there that we could use that actual cash to change our assortment and therefore turn that inventory and make more money. And I'll show you, we're going to look at turn at the end of class today. I'll show you what I mean by that. Okay, I think that's good enough. I think we've got it. So we're going to go through profit and loss again, and hang on, let's see where we're at. Okay. What a profit and loss does. How we're doing, the profitability in a given period, and what else we do with a profit and loss is we use this information, ideally, we're always going to use this information to make better, what I just talked about, pricing decisions, better profitability or margin controls, and better control the expenses. And this is the report, the profit and loss, that's going to give us the ability to do all that. And there's one great way to do that, and that's to bounce statements beside each other. And I don't know if your software allows you to do that, but it probably allows you to export it into Excel. And so if it does not allow you to line them up, I would encourage you export it to Excel so that you can line it up. So you can visually see the changes in what's happening in the actual time periods. Now, today we're using these annual statements. You could do this by month. If you got right down to it, you could do it by week, you could do it by quarter. But the key is for you to be able to compare like periods so that you can look for trends and understand where things, this is how you catch things that may need attention. Then my most favorite thing in the world is what I call common size statements. And probably if you take one thing away today, I would encourage you, this be your takeaway, is common sizing a statement. And really all that means is we're converting the statements to a percentage. We then don't look at the real numbers that appear on that statement. We look at the percentages and compare them. I'm going to give you some examples. Besides comparing us to us, which is a great starting point, We can also use this type of information to compare us to like businesses in our industry. And Bromwood has access to all that information. We have a multitude of resources that we can pull from that you can compare your statement, your cost of goods compared to your industry specific sales. Okay? It can be kind of eye-opening. Surprisingly, a lot of times I will have someone, they're actually doing better than their industry. They just don't think they're making enough money. But when they actually compare their statement as a percentage to their industry, they may be doing better. Because what do you think the average net profit is? If you lumped all the businesses of the world together and you average the net profit, what do you think the average? It's a little better than that. It's about 2%. But that's not a lot, right, guys?
I would say, though, I would think retail would vary from manufacturing.
It does. It does. But bottom line, it doesn't vary as much as you think. Well, you know what really varies the most is service to retail, and service typically has a higher profitability.
Well, I remember the first class I took with Isabel. Isabel's a counselor in Springfield, our assistant director, and there was a veterinarian who was not happy with his average profit margin, which was 15%, but sitting next to him was a restaurant owner at 2%. So he was complaining about his 15%, and the restaurant owner was just
going, hey, right?
Yeah.
That's what happens. Service providers, veterinarian, professional practices actually also have a higher net profit. It's very interesting. There is something to economics and how averages really do average out, and it's shocking no matter kind of where you're located in some regards, because now we're talking about percentages. We're not talking about a dollar figure. We're talking about as a percentage. Here is our last 4 years for this particular company in a common sized scenario. So let's talk through this very briefly. Do we have enough time to do that? Oh yeah, I'm good. Look across the top. You can kind of see what's been going on with sales. Now, when in a common size situation, what I have failed to tell you is 100% is always net sales. So everything after net sales becomes a percentage of net sales. So if I read that first statement, I would say in year 4, 58% of all dollars that came in to my company during this time period went to cover cost of goods sold. That's a long version of saying my cost of goods sold is 58% of my sales. Okay, and you can see now how obviously it comes that that's the largest expense. Because look at the percentages as it relates. And you can see that, that 1% website down there becomes really, really small when you're looking at 58% of cost of goods sold. So where am I going to spend my time? I'm going to spend it up there on my cost of goods sold. This also allows me to compare me to me. And if you look across, and again, I gravitate toward the biggest expenses, the ones that I hope I can control to make the most impact. Because as you all know, there are only so many hours in the day. So I'm going to use my time effectively. So if I look across there now, I have an aha moment. My aha moment is this. 4 years ago, my cost of goods sold was 53%. Last year, it was 58%. What are we going to tell him? What are we telling him? I'm telling him, wow, dude, you lost 5% to the bottom line, because if that would have been maintained at 53%, he lost 5% to the bottom line in 4 years. Now, it happens. And I know why this happened, but can you think of reasons why this happens?
Well, fuel, like there's a cost of living, like what is not accounted
That's right.
for.
That's right. Your costs may have gone up, and then what did you fail to do, or may you feel uncomfortable doing?
Raising prices.
That's right. Very common. Very common concern among small business owners, too.
Does QuickBooks have that feature to convert it to the percentage?
Yes. What QuickBooks cannot do is bounce 4 years across like this, but it will produce a common size statements. Okay. You can do 2. You can't do 4 in QuickBooks. You can look at the last 2 years side by side.
But then you can print out each sheet and what
You can, or you can export to Excel, which is very easy to do, and then bounce them. The key is what? To make sure your expense lines are consistent across. That's a great reason for why you want things to roll up, too. Okay, so what was going on? Look, 4 years ago, what was going on? He had a 2% loss. And he had a 5% lower cost of goods sold. So, hey, I'm going, wait a minute, what's going on here? So while I'm criticizing him that he lost 5% of his cost of goods sold to the bottom line, which in year 4 would have been $30,000, by the way. I can do the math pretty quick. 5% of $628,000 that could have gone to the bottom line if he could have maintained his 53% cost of goods. It's over $30,000. So it starts making some impact when you start putting the numbers to it. But what has he done a really good job of? I know that he eroded 5% cost of goods, but I also know that over the last 4 years, he's gone from a 2% loss to a 2% net profit. How did he do it?
Salary was lower.
How did he do it? Look at total expense. Look at your operating total expense. 4 years ago, it was 47% of sales. Last year, what was it? Ooh, that's a lot. Let's give him some points for maintaining his operating costs, doing a good job, right? You bet, because he has. But what else has he done a really good job of? Look at his sales numbers. Remember, in a common size situation, everything is as a percentage of sales, so his sales have really grown too, which is enabled, which is what? Which has really reduced his operating expenses as a percent of revenue. Because they've grown too, which they should have. Look, he's had remarkable sales increases. So while it's gone from 47 to 39, in dollars, it's gone up. Which it should have. Why? Because it's going to cost more to sell more. This is why common sizing, though, is so remarkable to me, and what a great tool it is in managing. And I'll give credit to someone who taught me how to do this about 35 years ago. And it was this elementary, because it's very hard to train your brain to not look at the numbers. Very difficult. And so what W.R. Appleby forced us to do is we actually took financial statements and we had to cut out. We made little stencils, and he would let us look at the sales number and the percentages and the accounts, names, but we only got to see the percentages. And so he taught us how to manage from that by looking at it that way, to get your brain off just looking at the actual numbers, to look at the relationships of how you're doing business so that you can improve upon that. And focusing on that, and focusing on the biggest, and focusing on the changes as it relates to sales. And it really works. And this is what they teach you in finance school, to really analyze, figure out what your relationships are in your accounting and interpretation of your financial statements. So I think we probably have made some pretty big discoveries already on this particular case, and we'll continue to do that as we do some ratios. Let's look at the balance sheet. Again, the balance sheet, a snapshot, a point in time. From day one, gave us the book value in the beginning, but it's only given us the book value. That value of $89,518 of equity may or may not resemble the real value of the company. The company could be much more value. Value in small businesses is really related to cash flow and capitalizing earnings. In other words, attaching a multiplier to the earnings is really the key in a small business. Balance sheets are not always the most updated statements in the world. Many times, small business owners will not update their balance sheets, but periodically. I would encourage you, if you can, to keep it as updated as possible because it will always help with the analysis of what you're doing. For instance, do you record your own depreciation monthly? Right. So, and that's okay. Depreciation is a non-cash item, and so we're typically not going to get concerned about it because it doesn't influence our cash, but it's going to be a way for us to reduce our net profit at the end of the year, and that's very common. But what you want to do is try to keep most of your entries as current as possible. That will enable you to actually analyze what's going on a monthly basis. Okay, again, what the company owns, what they owe, and the bottom line are the equity position at a point in time. This is a big equation. This will help you in the long run, thinking this through. Assets equal liability from a net worth or equity. Remember what assets are, what the business owns. Mine equals liabilities, what they owe, and the difference being the equity position. Whoops. Okay, so again, year 4, here we are. You know, you can look at a balance sheet at a point in time and you can make some statements about it, but the truth is to really do an analysis or comparable, you need more than one point in time. We could say something like, oh, they have $4,500 in cash, and that's not very much compared to how many assets a business owns. We could say that. We could say, oh, well, their customers owe them $106,000, but you know what? Since we don't know the sales by looking at this, we don't know if that's good, bad, or indifferent. It's always a comparable. So when we have multiple periods, we get a lot more insight on what's going on in the business. And now we can make some better statements, more knowledgeable statements. For instance, we know that 4 years ago they had about $20,000 in cash, and now they only have about $4,600. I have a sneaking suspicion that this business might be a little cash poor. That's not very much cash based upon what you know that their operating expenses are. We also know that, look what's going on with their accounts receivable. 4 years ago they had $61,000, now they have $106,000. That's almost doubling. If you had no other statements at this point, you would be, wow, they've doubled their accounts receivable. Why? Well, we know that they've almost doubled their sales too. So that might be reflective of that. Again, we're going to do some ratio analysis to tell us exactly what's going on with that. Because it's very hard when you just are looking at numbers because you're having to do all the conversions in your head. We're going to make it much easier than this. Bottom line, what's going on with, remember we talked about a little bit about debt and ongoing liabilities. We can also make some statements here in analyzation is they double their accounts payable. You know, is that good? If their vendors are happy, I call it good. Yeah. Their current liabilities though has more than doubled. Interesting, right? Their long-term liabilities is going down. They're paying down long-term liabilities. So they're switching that. We'll talk about that further in the series of, is that a good idea or a bad idea? We'll let them know. Again, common sizing statements is very valuable, and it's valuable with a balance sheet too. Here we can really see the differences in the changes of what's going on. In this particular case, the balance sheet, the total assets are 100%, so all accounts other than the asset account becomes as a percentage of the assets, and on the bottom as a percentage of liabilities and equity. So we can make some generalized statements here. We can say that, look, let's look at that bank loan again. It used to be 44% of their liabilities and equity. It's been reduced to 25%. They certainly have reduced their debt as a percentage of their liabilities and equity. But what's going on with their current? They've doubled their current. Remember what current means, to put it in perspective. Less than a year. That means that amount of money, those notes, and the current portion of the long-term debt, which means the next 12 months of principal payments, are due. So I've got to have enough cash, right? And we're going to look at some liquidity ratios that can be figured for you, and you can very quickly assess your ability to pay rather than looking at the numbers and trying to do the math in your head. It's just a simplification. Okay. Along with comparing you to you, there also is another key that Bronwyn has access to, and that's comparing you to others. These are some of our resources that we use to do that. Profit Sense by SageWorks is probably my favorite, and there's a reason for that. Profit Sense by SageWorks is in real time. It is the premier software that's going to produce standardized financial ratios, and it's going to be reflective of yesterday. So it's in real time. You can see the history when you look at these two of when the little 08, 09, 10 little crisis thing. You can see what it did to specific types of businesses. BizMiner is great in the sense that BizMiner's resources comes from the Census Bureau and the IRS. Again, it's a standardized, and I'm going to give you an example to pass around so you kind of have a better concept of what I'm talking about. But it's a comparable for you. It doesn't make it right. It doesn't make you wrong. It's just something for you to review and to compare it to if you want to compare it to somebody other than yourself. You know, how you doing? Remember that the person that thought they were doing terrible when they had a 15% net profit, and I'm sure if they compared it to an industry standard, they were still better than the industry standard, because that would be very rare to have a 15% net profit. So if you have a 15% net profit, you know, you probably should be teaching the class maybe, you know, if you're doing that great, because that's great.
I'm sorry, is this to pass around?
Yeah.
How big is the geographic area of a report? Like, I know it does.
It's a good question.
Yeah, like.
Because it does matter. Profit Sense you can pull by region if the industry is big enough. And you can pull it by state if it's big enough. Some BizMiner reports you can do that way too. But normally you can be assured you could pull it by national. But it's the more narrow you can get, obviously the better. You're comparing it to more like businesses. Now, you guys may have an association that perhaps publishes this type. Does Kawasaki, you know, present you rules of thumb or averages for industry standards?
No, but there's some business groups that do.
That's exactly. Those are great. And truthfully, that is where you will get the best, most relevant information. I would use those. I mean, you can look at these, and you're more than welcome. We will give them to you free. We can access them. It's a very expensive little database we subscribe to. It's like $10,000 a year.
It's based off their industry code, NAICS code.
Your NAICS
So
code.
just email me a NAICS code, and
Yep.
you can get your report. And usually, Paige does the reports in her office, and she's very good. She almost always gets them to me within 24 hours, so.
Yeah.
The MyPlan software takes it by region. They only, you have.
Are they publishing industry standards now again?
They have the benchmark, so.
Oh, they do? I thought they pulled it out.
They pulled out the financial ratios, and
Oh,
that's silly.
yeah.
But, and I don't think they do. In fact, I wrote it down to ask them about
Okay.
the common size statements, because I hadn't seen that before, so.
Okay.
I don't think they have that.
I don't think they do either, because I just remember being disappointed. Okay, so anyway, your industry associations, the best, the absolute best. If you have access to that information, perfect. I would use that. I would set it up. I would even go, I might even go to the point of goaling to it, you know, because, you know, this is telling me how maybe this is average, or if I'm doing better or worse, or, you know, maybe how I can improve. But we also have that information available through the SBTDC. Okay, let's take a break. Am I okay on doing that? Okay, let's take a break, maybe 10 minutes, just kind of stretch our legs, and then we will burst into the ratios.